Okay, so good afternoon, ladies and gentlemen. Welcome also from my side to this SRM 10th years anniversary, and welcome to this very interesting panel about funding in resolution, liquidity in resolution, which I think becomes a trending topic after the first two panels, where I think that there were some discussions already about the topic. I'm really happy and honored to moderate this panel today, because I truly believe that this topic lies at the heart of financial stability. So we are talking about how to ensure liquidity when we have a major failing bank. So let me perhaps just set the scene a bit. So we are on Monday morning. We went through the recap weekend. We applied different resolution tools, be it bail-in, bridge banks, sale of business, etc. And then on Monday, we have a very solvent institution. But hold on a sec, where are the investors? Well, most probably the investors have gone. They need a bit of time in order to restore the confidence in the bank, and in order to be able to put in place the necessary funding. So we need a bit of time. And this is why, even if we communicate properly the resolution scheme and the resolution decision, the first hours, the first days, weeks after the recap weekend are so important, and financial stability is at risk. So this is why we need to be able to put in place some sort of liquidity facilities, ensuring that the bank can open doors again on Monday morning. I think that in the recent cases we had in 2023, we saw how important it is to ensure these liquidity lines on Monday morning. And what did we do in Europe? Because, I think that we have to be proud. And we achieved a lot of things during the last 10 years. And it was a journey in which it is not only the SRB or the European institutions, but we have done a lot together with the banks, right? I think I want to highlight this, that the work that has been done was a joint effort between the European institutions, but also within the banks. So we built up a single resolution fund, which now holds 80 billion euros, right? But then the main question is, would this be enough for a GC failing? Would this be enough for, on Monday morning, covering the liquidity needs of an institution? Well, if we saw the recent cases in 2023, most probably the answer is, for some cases, it won't be enough. There were some, I think that someone mentioned in the previous panels also the backstop. Well, we've been working on the ESM common backstop for already some years. Personally, I devoted a lot of time on this discussion, but unfortunately, we don't have it yet in place. But even with the backstop, which will be adding another 68 billion euros into the equation, then the question would be again the same. Would this be enough? So SRF plus the backstop, in total around 150 billion euros. Would this be enough for a failing GSIP? Well, we don't know. We have some doubts. So I really think that we need to push in order to find the European solution for this liquidity in resolution. So this is why I'm so glad moderating this panel. And this is where we are. So Monday morning, what can we do? How we can ensure the liquidity needs of the resolved and very solvent institution again. So with that, let me introduce the great group of panelists that I have today here with me. And I will do it in alphabetical order. So Denis Beau First Deputy Governor, Banque de France. Please join me here on stage. Roberto Cercone, Director, Resolution and Crisis Management Unit at Banca d'Italia. Alain Girard, Head of Recovery and Resolution Division in the Swiss Financial Market Supervisory Authority. Seraina Grunwald, Professor of International Economic Law and Financial Law, University of St. Gallen. And then Pamela Littner, Senior Financial Sector Specialist at the World Bank. Thank you very much for joining this panel today. Thank you. So, many thanks. I think, that the first question, which will be valid for all the panelists, and I think it's very straightforward, in the sense that based on the recent cases that we had in 2023, what would be, in your view, the most important lessons learned when it comes, of course, to liquidity and resolution? Denis, we can start with you. Thank you.
Thank you very much, and good afternoon, everyone. And thanks for inviting me to take part in this discussion. The short answer to your question is, for me, operational readiness to access funding facilities. I must say that as a practitioner of liquidity crisis management over my career at the Banque de France, I've learned, I think, that lesson, that speed in action is really essential when you face a crisis, and in particular involving liquidity issues. And I would say it's all the more important in the digital age we have entered into. Might come back to that. So I believe this lesson is true for resolution management, and the importance of being operationally prepared is really essential. And there are lessons that you can draw from, for instance, the SVB case, where I think it has been documented that, unfortunately, and it complicated the management of the case, SVB had not tested its capacity to access the discount window and had not appropriate procedures in place. So being prepared, it involves a number of things. First of all, to be able to assess its liquidity position, the collateral you have, to be able to mobilize it. I think it's really important to test that, to ensure that you are not prepared for a period of time, but on an ongoing basis. So that's, for me, a major lesson to be drawn from recent cases.
Yeah. Many thanks, Denis. I cannot be more in line with what you said. And this testing and this operational readiness should be put in place now, in peace times, and perhaps not when the crisis comes. Many thanks. Roberto, from your point of view, please.
Okay. Good afternoon, everyone. Thanks, Miguel. Well, I think the most important lessons is, I would say, the speed. The speed which affected the unfolding of the crisis and also the reaction of the authorities. And I think it's the most important lessons, not only because this was clearly a peculiarity of the crisis of 2023, but because the speed seems to be rooted on structural changes in the banking business, in a change of paradigm, which is the massive application of digitalization and prospectively of the artificial intelligence in the banking business, relationships with customers, mobility of customers' funds, and also the proliferation of decentralized information, public communication, which is the social media, which lacks a fact-checking system. So all these things seems to signal that the speed could be the real new characteristic of the future banking crisis. And of course, from this point of view, the speed has affected and affects, again, the outflows of deposits, as we know, the exhaustion of the liquidity of the bank, and also the reaction of the authority, and even the overreaction of the authority, which, of course, when you have not too much time, you have to deploy much more that is technical necessary in terms of capital and liquidity support for gaining and restoring the confidence of the market. My only another comment on that is about the fact that we have probably a gap in the regulation, because the resolution framework is much more devoted, much more attention to the capital needs than to the liquidity needs. And we know that there is a low level of interaction between the capital soundness and the financial soundness of bank. It is not true, or it is no more anymore true, that a well-capitalized bank is also a liquid bank. So from this point of view, we have in the resolution framework tools for generating capital internally to the banks, the MREL, the bail-in. We do not have the same tool for generating liquidity at the time of resolution. So this, maybe it's really a gap we have to close. And of course, there are a lot of possibilities, a lot of discussion on possible way out for that. I just mentioned two of them. One is to think to systems which are aimed to prevent and manage the liquidity crisis. So one point could be to review the deposit guarantee scheme regulation, increase the level of protection, question mark, recalibrating the protection, taking into account also the maturity of deposits. There are jurisdictions like Japan where this is already in place. We can speak more closely on that. The second line is, of course, to introduce some regulations, some systems for strengthening the ability of the bank to generate liquidity at the time of the resolution. Here, one possibility is to have a requirement of having a certain amount of unencumbered assets to be used as collateral, not in the ongoing phase, but during, at the time of the resolution, which is different, just a little bit different. My rapidly only comment is about the importance of public communication. And here, we can wonder if the banks and the authorities can have a more active role on this field, but I don't want to elaborate on that.
Many thanks, Roberto. So indeed, legal gap. And now I'm really, because in the previous panel we saw also the industry, the CEO of Banco Santander saying that it should be good to have the liquidity solution in place. So I think that as a first step, now all the institutions, but also the industry, we acknowledge a bit that indeed there is a legal gap within the regulation, and perhaps this is the first step for moving towards the final solution. Alan, from your point of view and knowing that you've dealt with a big case a couple of years ago, what were your lessons learned?
Thanks for inviting me first. It's really a pleasure to be here. It's an honor, and also to contribute to this achievement of the banking union, or the single resolution mechanism. I think from outside of the banking union, I can say that's something that we are impressed that you have been doing during the last 10 years. When you ask me about the single most lesson, I only can answer that question with multiple adjectives, because when you come out of a crisis, you have a lot of lessons, but I'll try to give you just one sentence, but with many adjectives. So when it comes to ensuring adequate and timely funding in resolution, the lesson is that it has to be massive, prepared in advance, operational, and flexible. It's an ambitious agenda, but let me just dive in that a bit. It has to be massive because balance sheet size matters in a crisis. And I can only echo Roberto that says something, I think all what you have to say on that is that technology, from mobile banking, 24/7 payments, social media, just doesn't ease the challenges. So they are just bigger challenges than they were before. So faster bank runs means bigger volumes, and therefore massive crisis funding is a necessity. It's not like an option. Then that's my second point, or my second adjective. Adequate and timely funding and resolution must be prepared in advance. I read somewhere that it is a saying from Finland that you can only prepare in advance. And I think that's absolutely true in the context of funding and resolution, because you need for sure a robust piece of legislation. You need a mechanism that is enshrined in legislation, but that is also understood from the authorities, and that the competencies for the central banks, the resolution authorities, but also the supervision authorities is well understood. So this is what we call in Switzerland the public liquidity backstop, and I will dive deeper on that later, maybe in this panel, but I think you need this robust piece of legislation, and you can have that only when you have good weather. It's not during the crisis that you can do that perfectly. Then you also need to ensure that the full potentials of the bank's collateral pool is possible to be activated in a crisis. That means that the lender of last resort and also the banks that are part of the systems need to have a clear understanding of how it works, and also to have a full potential, because it is not really useful for financial stability if you have a pool of collateral that is existing but not useful in a crisis. I think that that's a very important point. I will dive deeper on that also later. But then you also need high going concern liquidity. Why is that so important? Because you mentioned Monday morning in your introducing speech. But not only Monday morning is important, it's important to get to the weekend. And because of that speed, we think that high going concern liquidity requirements are also very important. Dominique mentioned this continuity between, let's say, business as usual, turbulences, recovery, resolution. I think we need to think of the system with these 3 lines of defenses. I will say something on that later. During the crisis, it is hard to improve these elements. But before the crisis, you can do that. So that's the reason why I say just prepare in advance. Mm-hmm. Finally, it has to be operational and flexible. That's the typical parallel that we do in this business, but the firefighters are a very good parallel. No firefighters know where is the next fire going to break out. That's the same for resolution authorities, that's the same for supervision authorities, even though normally we know where it smells not that good, so we know maybe where we might have a crisis later. If you look at Credit Suisse, I mean, it was not exactly a bank that you would think about that we had no crisis. The confidence element was a big part of this crisis. So I think that every systemic crisis needs its specific response, and for that reason, we need flexibility in the framework. And you have flexibility only if it is operational, and you have the legal certainty to make sure that the options you think about are able to stand for courts. So I will stop here, because I will be probably happy to dive deeper in the Credit Suisse facts later in the time dimension. But for the single answer, that's my long list of adjectives.
Many thanks, Alain. Highly appreciated that you share with us your real lessons learned or experience from a real case. Now, Seraina, from your point of view, being a professor of international economic law and financial law, so from the academia, how do you see, or how did you see the recent cases and the lessons learned?
Well, first of all, thank you very much, Miguel, for having me here today. It's a great pleasure to sit on this distinguished panel. It's always hard to be the fourth in line to answer if you agree with everything that has been said before. So I don't envy you, Pamela. But let me maybe frame this, in a bit differently by going back to 2014 when the key attributes were drafted, right? And already at this point, we knew how important funding in resolution was. It was not a priority at the time because we focused on the liability side, ensuring sufficient loss-absorbing capacity, but it was part of the key attributes, and it was part in 2016 of the guiding principles that were released. So it may make sense to just reflect on these principles quickly. And that will recall a lot of the things that have been said. It says there, essentially, that funding in resolution should be sufficient in size to cover virtually any liquidity gap, right? Miguel, you said before, we don't know how much liquidity will be needed in a GSIB failure. We have a rough house number from our experience in Switzerland, right? Roughly 170 billion euros, equivalent in Swiss francs. Then the second principle is timeliness, that has been mentioned several times before. Funding needs to be available on very short notice. It's also an experience that we take away from the crisis, right? Also in the US, where there was virtually no runway period, right? In Switzerland, we had same-day execution in terms of liquidity needs. So that speaks to the need for preparation and operational readiness, right? And then thirdly, and I think that's very, very important, is that the framework is credible. You alluded to that, Alain. That it's predictable for markets, that sufficient and timely funding will be available. So it needs firm establishment in the law, a governance that is not overly complex. I think we can work on that in banking union. That there's clear responsibilities and a strong role for fiscal backstops emerged. Of course, here we have a gap too, and we can speak about that. So maybe just in conclusion, a fast forward, where do we stand? We heard from Travis Hill, they're also working on their funding and resolution. We certainly are in Switzerland, banking union is. We are not there yet. If I recall correctly, it was called the weakest link, right, this morning in the poll. So I'm looking forward to discussing in the panel. Thank you.
Many thanks, Seraina. I can already confirm that you have added value to the conversation and you mentioned different points, so it's okay. Many thanks. Pamela, now.
It's very tricky now to add something. Maybe let me start with a more surprising case in one of our client countries, talking about liquidity. We have seen a resolution case where there was a deposit inflow over the resolution weekend. That was under very special circumstances, very idiosyncratic. But just to give a bit of a flavor, what can happen. It's not that we advise our client countries to prepare for such a situation. It's rather what you are talking about, the fast speed under new technology is the thing you should prepare for. One element we do think is very important to have when it comes to liquidity, especially in a framework where the government backstop is regulated more conservatively, as is the case in the EU and also under the BRRD in our client countries. Most of them are more or less fully BRRD aligned. Is the application or the need to have moratoria in the toolkit. I know many people criticize the moratoria, they might postpone, they're not a final solution, but it was already mentioned, a lot depends on the communication. And when we run our crisis simulation exercises, we see that sometimes are maybe too easily applied, but they are important to have just to bridge the time gap and then bring the country or the case to the bank to the resolution weekend. And one other element, which is more specific also for our client countries, we are working in emerging markets, all the EU accession countries. You did say that capital is solved. I agree on that. MREL is, banks are compliant in the European Union. In our client countries, this looks quite different. They are all operating in deposit funding markets. They don't have capital markets developed, non-existent in many cases. And even in countries where MREL is raised, and some actually are close to fulfilling the target level, it is mainly fulfilled with capital, which raises the questions, on the point of triggering, the legal risk of triggering too early. And here, what I think we do see and learn from recent cases, also European cases, is the question on who should be protected and the uninsured depositor funding question. And that's where we would argue there could be a need for more flexibility to access industry funds beyond the MREL. So, some outsiders' views.
Many thanks, Pamela. So, Denny, let me now come back to you. I think that France has been always advocating for a stronger banking union. But how would you see the role of the central banks when it comes to this liquidity and resolution, highlighting that the banking union is not yet completed?
Oh, thanks for this question. I mean, if you look at former cases, and maybe referring to the Credit Suisse, but you might address that. I think the Credit Suisse case is a good illustration of the importance of central banks' liquidity during banking crisis. And the SNB has lent a lot of money under special conditions, and it was helpful. So I think it's fair to, and it was mentioned several times this morning. We have maybe a missing element in the framework currently, and to be very concrete, we lack a central bank-based standing facility of some sort. I mean, to be part of the toolkit, so that it's one thing to recognize that it would help, because you were. It was striking to me the way you put the issue, saying, well, we have a first line of defense, a second line of defense. Is it enough? So where is the end? And the lender of last resort might be part of the solution. So it's easy to state that. It's more difficult to find a framework to have central banks, and in practice in Europe, the Eurosystem, intervening. There have been discussions around this issue for a number of years that have not been conclusive. So, I mean, my personal view is that if an important step to strengthen, our framework would be to resume those discussions and to find a way to have a contribution of the Eurosystem. But there are a lot of constraints to address, which explains the difficulties to come to an agreement on that front. I mean, they are legal and institutional constraints. I mean, there is a prohibition of monetary financing. There is the independence of the central banks. To quote a few dimensions which need to be addressed to find, a setup in which, the central banks would feel comfortable to provide a part of the solution, at least in funding. So to answer your question, it's banking union is still incomplete. Your system can be part of the solution. It's important to resume the discussion, but it's likely to be a difficult one, because the number of constraints to address are really difficult to overcome.
It is really, really difficult. I've been discussing this for the last 5 years. We didn't find the solution. So let's see, if in the next 5 years we finally find this solution. Roberto, let me also come back to you. I think that you also in Italy have navigated some challenges in the recent times, and I think that Alain has already mentioned some sort of different features that we have to put in place. But what, in your view, should be prioritized in order to be able to make real progress when it comes to funding in resolution?
Well, in Italy, we some years ago, we put under resolution 4 banks at the same time. They had totally 30 billion of euros of assets. and they represent more or less 1% in market share in terms of deposits and loans. This was the situation, and we used the bridge bank tool because no acquirer was potential acquirer was willing to buy the bank. Of course, the bridge bank is the worst tool for resolution authorities, as we know, but is the only one when you have no chance to do anything else. These banks experienced in different moments of the escalation of the crisis, even after the resolution, experienced serious liquidity crises in correspondence of the spikes of uncertainties when approaching the resolution, just after the resolution for the disaffection of customers vis-à-vis the bank under resolution, and even when it comes the sale of the bridge bank because the uncertainty on the process. This moment of crisis, of liquidity crises, were solved basically using the internal liquidity of the bridge banks. But that was because the bridge banks were recapitalized by the National Fund, Resolution Fund at that time, by using cash, basically. So they were very liquid at that time. So again, internal funding, but with the assistance, in this case, of an external support given by the Resolution Fund. And of course, the existence of the Resolution Fund was essential in order to restore the market confidence, because people in markets knew very well that there was a resolution fund ready to intervene in case of need. So if you ask me which is the priority, of course, the first priority remains the first line of defense, of course. The banks has to be liquid, has to have the ability of generating liquidity in case of a crisis, so that's clear. But I would put at the same level of priority even to have in place an ex-ante external funding mechanism. In that case was the resolution fund, of course. It may be different, but this is essential. And this external mechanism, of course, requires for large internationally active banks, of course, cross-border coordination, but in any case, it requires also a strong interfunctional coordination because different authorities are called to intervene or to coordinate their action, meaning, of course, the supervisor, the resolution, but the central bank, as I said before, the state for the guarantee if needed, and of course the deposit guarantee scheme, which is also a potential liquidity provider for this case of crisis. Now, you asked at the beginning of this session whether the Single Resolution Fund has enough money for... I would expand this question because for us Europeans, I think the crucial question is, would we be able to deploy the exceptional measures that other jurisdictions were able to deploy in case of crisis in European Union? I don't want to answer this question, but I just conclude my comment by recalling some truths we know. First, we in Europe do not have an ex-ante financial stability exemption, which allows the authority to intervene when the financial stability is at risk. Second, we have state aid rules, which affects also the provision of guarantee by the state, for instance, for protecting the central bank liquidity provision. Third, we have a real complex and efficient governance with two different levels interplaying each other. The EU level for the Single Resolution Fund, for the Single Resolution Board, for the state aid rules, and the national level for emergency liquidity assistance, for state guarantees, for deposit guarantee scheme. So this is a real a mess, if I may say. So again, just for concluding, here there is a clear need for, of course, continuing with the harmonization, that's good, but for going in the direction of centralization of the decision, particularly when speaking about liquidity needs, which course, as you said, under real time pressure. So we need to complete the banking union, of course, and perhaps we need to be open to the perspective, which is not technical perspective, of course, of the EU fiscal backstop, basically,
exactly.
at the end.
Yeah, absolutely. Many thanks, Roberto. Alan, perhaps digging a bit deeper into the Credit Suisse case, where, of course, a big amount of money was needed, and this translated into sort of regulatory changes. And I was always thinking how the time pressure played a role when, taking this decision and when trying to accommodate a bit the regulation for those changes.
Well, I think I can answer that one quite straightly. Time pressure is always useful to find solutions. But let me elaborate a bit on maybe two elements. The one is the system I mentioned, the 3 lines of defense, and what it means in Switzerland with the regulatory perspective. And I think I can also add some added value when I bring these 3 lines of defense into the very specific situation of the Credit Suisse and the time dimension of that crisis. So now we are using that system of the 3 lines of defense also to enhance our regulatory framework for liquidity in resolution. And we think about these 3 lines. The first line is liquidity that the banks hold on its balance sheet. And this encompasses things like central bank liquidity, other assets that can be converted in cash. I mean, we all know these pre-positioning issues, but this is the first line of defense. The second line is, this is the HQLA of the bank has to have in going concern. The second line is this collateralized central bank liquidity. And this is for situations when banks have problems. And I think this is an element that the Swiss National Bank has been recently outlining a lot. And the system is improving in Switzerland. So now it's not only for SIPs, as it was in the past. It is already open up for all banks. Yeah. And that's the kind of improvements that are very important because, as we said earlier, you don't know where the next fire is going to break out. So the third line is commonly referred in Switzerland as the public liquidity backstop. And the word backstop or public or liquidity, all the 3 words are important. And I think that's something that Robert has been referring to when talking about the European Union. But we had to do that via emergency liquidation in the Credit Suisse crisis. So we had no public liquidity backstop in orderly legislation. But we knew that before the crisis or during the crisis. So for that reason, we were able to prepare for that, and we were able to make this possible in the crisis. And that's where I will start to let play this time dimension. When we were in October, exactly 3 years ago, so mid-October, 3 years ago, we are in a bank run. Credit Suisse is for 10 days already, so October 3rd was the first Monday on October, and on that day they had a double-digit billion outflow from the weekend in Asia. On the second day on that week, it was the same, even more outflows. It was going on for more or less all the months, as we know now. And during this time, you see why the first line of defense is important, because it was so fast that it was just because Credit Suisse was probably the most liquid GSIB at the time. They had more than 190% of LCR, meaning they were able to pay out their own HQLA, so liquid assets. And that is, when you take the perspective of a resolution authority, it buys time. So you are able to prepare for probably the next sequences of a crisis. So you see here the first line is already important for resolution because it buys time to prepare in the last minutes. During that time, as is now public, thanks to the great work of the FSB, we decided to change our assumption about runway periods. If you look at books, you will see, 2 to 4 weeks you can prepare for a resolution weekend. That's just not true anymore. We set the deadline on 7 to 10 days. It's the occasion to make a big thanks to the Dave Ramsden and others that was in the crisis management group of Credit Suisse, because if we decide to put 7 to 10 days as a level, then all the CMG members have to do the same. And so we were really having great partners in that group that make that possible. At the end, we had 4 days, but we had the nights, so it was possible to make it. I go now to the backstop, because I would have loved to have the backstop in legislation already at the time, because it would maybe have a preventive effect as well. Maybe I would not be here talking about that crisis now. But still, all the authorities in Switzerland knew that there will be no solution without liquidity support, independing which solutions you may look at. So the merger with UBS or a single point of entry resolution and restructuring, you need liquidity support. And since the authorities had this conviction, they prepared for that. And for that reason, it was possible overnight on March 15th, so on Wednesday night over to Thursday, to have legislation in place. That was emergency law, but it was on Thursday night already in place. So we were able from, let's say, Thursday night to Sunday to prepare for resolution, because we know we have bail-in capacity, we have to do the jobs with the CMG so that we are all prepared for that, but also we have liquidity support. And this is probably one of the most important points for Sunday night, for the central bank saying, we will provide liquidity, and we have a backstop from the state if we need more liquidity than what is possible. So I think you can see in the Credit Suisse crisis that the 3 lines of defenses are all important. And for that reason, we will now use this, let's say, window of opportunity to change legislation to make sure that the first line of defense stays as good as it is, because we had amendments of regulation before the crisis that were very meaningful, so it has to stay like this. But for the second and the third line, we still need improvements in Switzerland, and I really hope that we will get to that point soon in the future.
Many thanks, Alan. Extremely, extremely interesting, and indeed highlighting again that as we said with Denny, that we need to make progress now in peace times, and not to wait until the next crisis is knocking at the door, because then it will be extremely complicated, as you are describing, to find the solution on a Saturday night, discussing with all the actors involved. Many thanks. Seraina, I think that we've mentioned already those sort of legal impediments, no, or this gap in the regulation. But what are, from your point of view, the biggest structural and legal impediments that we have to overcome in order to find the solution? Difficult question, I know.
Yes, I was just going to say, very easy question. No easy answer also to that question. Well, it's clear that constructing a credible funding and resolution framework is significantly more complex in the banking union than in other jurisdictions. I think that's a fair thing to say. And that has institutional reasons, that has legal reasons, that has constitutional reasons that we are aware of. I think the key underlying difference is, of course, that we are dealing with 21 national budgets, we are dealing with 21 finance ministries, we are dealing with 21 different frameworks for emergency liquidity assistance, right? Yeah. So here is the pain point, I would say, that there is no natural fiscal counterpart to the SSM and the SRM. Now, that is not going to change, I would assume, in the next 10 years. So we have to work with the framework that we have. And thankfully, there is some pieces of the puzzle that we can work with, I think, in a more pragmatic way. Of course, the ESM, I want to have said that too, the ESM can fill the void to some extent, but of course, with all the caveats that we are well aware of. So let's maybe briefly look at these different pieces of the puzzle. We've mentioned the Single Resolution Fund, the big milestone. It's worth to say that again now on the 10th anniversary of the SRM. It's something to be proud of. But even if we assume that the ESM backstop will be put into place, right, we still, and thinking back to the guiding principles, we still have a problem of size, a problem of firepower. And I would also highlight a second problem, I've alluded to it before. We also have a problem of complexity of governance, right? And that puts the credibility of that framework into question, right? If you have 21 currently still 20 ESM members that can veto that backstop, potentially, that is not a very credible mechanism to the market. So here, is room for improvement. Now, as was mentioned before, other jurisdictions rely more on their central banks, right, in providing liquidity facilities. Not so much in banking union. That has to do with the fact that emergency liquidity assistance is a national competence. So, of course, there is some guidance in the agreement of the ECB on emergency liquidity assistance, but overall, or the bottom line is, the collateral requirements are determined by national central banks. Hence, there is differences in these requirements in the 21 participating member states. Now, this structural ambiguity is, of course, also difficult to reconcile with the need for certainty. I see you nodding. It is not a very helpful source of funding, but it's definitely not a source of funding that we can just neglect. So it's one piece of the puzzle that we have to keep working on, even though, admittedly, the fragmentation, of course, reinforces something that we want to work against, namely the bank sovereign nexus here in banking union, right? So, good. So what is the solution? I very much am with you, Denny, when you say, there is a need for the Eurosystem to play its part. I think there is no way around involving the ECB in the solution. Now, the ECB has historically been reluctant to assume a role as provider of liquidity and resolution. It has legitimate concerns. You mentioned independence, alignment with mandate. I think other central banks have these concerns too. You mentioned the prohibition of monetary financing. That is a specialty, of course, of the ECB. But, other central banks also require banks that they lend to be solvent, and we all hope that a bank will emerge solvent from our resolution. So I think that's a problem that can be solved. So I think the main pain point here rests with the problem of adequate collateral, right? High-level collateral will typically not be available, and it is clear that the ECB could be a liquidity provider, a very powerful one, right? But it should not be the risk taker. So we have to find solutions to ensure that this doesn't happen. Different proposals are on the table, ranging from bonds issuance that can be lent to banks, guarantees, and so forth. But here is where the framework that we can work with. Thank you.
Many, many thanks, Seraina. And I cannot resist. In every meeting now I attend, and it's about simplification, then I'm always saying that a way to simplify is more Europe, right? So more Europe is a simplifying factor, right? And having only one single rule book and not 21, it's a way to simplify. Thank you very much, Seraina. Pamela, working at the World Bank, and seeing different jurisdictions and different frameworks, where do you see the main differences when it comes to resolve crises of this type?
So if I had to break it down to one word, it would probably be flexibility. A blend between optionality and flexibility. Mm-hmm. It's clearly something we do see outside of Europe, and to a certain extent also with countries which are in principle BRRD aligned, but which do use the optionality under the dual track regime to apply alternative transfer regimes under national liquidation. Almost all of our client countries do have, already before the BRRD, they had these administrative administrative resolution tools or transfer tools in place. So for them, it's easier to operate on this dual track than for most European countries, apart from some thousand countries. That's one part. At the international level, we clearly see also more flexibility in direct access to industry funds. In South Africa, for example, or in Mexico, equivalence to the MREL or to the LAC would only apply to the systemic banks. For the smaller banks resolution, even if they operate under a harmonized system, they can directly access industry funds. That's much more complex and difficult in Europe. I know that the CMDI reform goes clearly into the direction of flexibility, but from our country's perspective, the issue is it is still very much MREL based. Yep. We have seen big success stories in European countries. I think Romania was one of the countries where the capital market development really worked well, including with the help of IFI anchor investments. In many of our client countries in the Western Balkans, the starting point is so different, and we would really not see there are huge challenges to issue MREL debt in the immediate future. We hope that EU accession would kick in earlier than the capital market development. One last point on the liquidity issue and also on the access to industry funding. In many of our countries, we see a much higher level of formalization. Obviously, it has to do with what you just mentioned. Intergovernmental sector setup makes it much more difficult. At a national level, it's easier. But many of our client countries do have memorandum of understanding in place between the resolution authority and the DGS. That could be something I would expect for the SRB to be also relevant under a CMDI reform, where you will have a more discretionary use of the DGS. So these memorandum do regulate cooperation, information on valuation, lesser cost test. And on liquidity, some of our client countries have tripartite memoranda, which do provide a public backstop funding for the DGS and for the resolution fund. It does not mean, that the money will be provided in the end, but at least the ministry, and that's the probably nicest thing when we have accompanied our resolution authorities, when they reached out to us, asking us to help them in the negotiations, the ministry originally thought to have no role. They were not really aware about this need. In a bail-in, there could still be some need for public support one way or the other. So that's good if you can prepare for that via memorandum, or the other alternative would be simulations, of course.
Absolutely. Okay, many thanks, Pamela, also for those ideas, forward-looking. We will see what is the final text of the CMDI review. I'm looking at the time, but I think that I still have time to go for one last round of questions, and then I would like to open the floor for questions here in the room. So, Denny, last question for you. Looking a bit beyond the banking union and those cross-border operating banks, do you also see some risks of liquidity in different currencies? This could be also...
Right now, you mean? No. No, I mean, we know by experience that periods of tension, market access to foreign currency can dry up very rapidly, and we follow as practitioners, I mean, a number of market indicators. This being said, there are a number of safeguards or safety nets that have been developed over time through the crisis. I mean, in the hands of the central banks, a line of defense is the swaps dealt or struck between central banks. I mean, and it has proved really helpful in a number of circumstances, including during COVID. post-COVID time where these the standing facilities, so the liquidity is provided through monetary policy operations, but the funding comes from those swap lines. So there is in place, I mean, public central bank-based line of defense. I'd like to say that the first line of defense is proper liquidity management by the banks themselves. I mean, in terms, when you have multi-currency activities, your funding policy and in those currencies is very important. And here, sound risk management principles should apply in terms of starting with the diversification of counterparties. So to answer your question, for sure, there is, of course, an additional dimension that needs to be taken care of, but we do not operate in a vacuum, and there is a part of the framework we have in place covers, I mean, that dimension already.
Many thanks, Denis. Then, Roberto, also last question for you. I think we are celebrating today the 10th years anniversary. We've made a lot of progress in resolvability and resolution, but where do you see now the banks when, I mean, the readiness in terms of liquidity?
Yes, the liquidity was one of the main working priorities for, at least for SRB banks.
Yeah.
In 2021, basically. And here, I could say, also looking at the results of the resolvability assessment made by the SRM, I could say that there have been a lot of progresses on this area. In particular, banks have demonstrated their ability to do the basic and initial essential things, which means mapping the needs of liquidity and the possibility of mobilized assets for facing liquidity crisis. On the first aspect, I have to say that the bank has increased the ability in mapping the needs in case of both slow and fast outflow scenarios. This is of course important, and also when approaching to the resolution and even after the resolution. So this ability to have a look along the escalation of the crisis from the point of the liquidity needs, it's important, and here the banks has made a lot of progresses. At the same time, they have improved the ability to identify and potentially mobilize the assets which can be used as collateral in case of needs. So the mapping of needs, mapping of internal resources, of course, useful to generate liquidity. And they also devoted attention to the identification of possible obstacles in the liquidity flows from within the groups or from one bank to another one, which is also important, regulatory obstacles, legal obstacles, and so on. Of course, we need to do further work, which is in particular related for large banks on the cross-border aspects. One is the liquidity in foreign currencies, of course. The other one is the possibility of liquidity flowing across jurisdictions, which is also important. And of course, it's important not only to reach the ability to face these challenges, but also to be able to keep a long time this ability. So here testing is essential as in any other area of the resolution activity. One additional point which is not on the table, I think, but could be interesting to be further investigated is the ability of banks and also of the authority to face the emerging challenges linked to the digitalization and the artificial intelligence. Here the question is if the banks and the authority should have a more active role in social media. which can be a passive role, meaning to be able to monitor the social media in order to capture the feeling of the markets and of the customers. And this analysis could be also useful if linked to the analysis of the outflows of deposits, because it can, if you put together what in social media is said about a specific bank and what is happening on its liquidity, it could be an interesting tool for understanding and perhaps for anticipating what can happen. The other point, which is much more tricky, is the possibility of having an active role, which means to interact on social media. Here, I don't want to elaborate too much, but the problem is, first of all, the never-ending trade-off between the disclosure and constructive ambiguity. This is a question for the authorities, of course, but also for the bank. The second point is the intrinsic risk of ambiguity of the communication here, which is a one-way communication. So the risk of unintended consequences is very high. If I say that the authority of the bank, the authority basically says that it's ready to intervene, this can intend that, oh, okay, no problem, there is someone who is thinking to solve problems, or in another sense, but is there a crisis? I have not idea of that. And if the authority feel the need for reassuring the market, perhaps this is a very large crisis, perhaps the situation is critical. Mm-hmm. So here, I would put a question mark on that, basically. If I have 1 minute, but I don't have 1 minute, so, okay, I stop here, then if there's time, I would add something, okay.
Many thanks, Roberto. Indeed, I think that we are running out of time. So, Alan, very quickly from your side, based again on the experience of the last crisis, would you say that now the Swiss regime is okay, or would you think that additional changes are needed or to be implemented, knowing that, of course, every case is completely different, but just based on the lessons learned?
Well, to say that we are arrived there where we want to be would be wrong, because we are on the way to get there. In Switzerland, 1 year ago, the Federal Council proposed 37 measures to be analyzed, and now we are at 22 in this June this year, and these are measures for supervision, for liquidity, and also for the crisis framework. And if I can go on to that part, because this is the most important to me, is that the crisis framework has to be improved as well in Switzerland. And I think, well, we published some, it doesn't have to be very complicated, but we published like a 4 pages fact sheet on that, because if you want to resume it, you need optionality, call it flexibility, optionality, but you need to accept the circumstance that in the crisis, you have to be able to tailor the answer to that specific crisis. You don't know that in advance, so you need the flexibility to handle crisis. And I think this principle is important. That what does that mean for regulation? It means that the instruments that you need in the crisis, capital instruments, liquidity support, governance measures, but also the whole strategy has to be possible to be decided on during the crisis. If you want to be able to make that kind of decisions during the crisis, you need a good piece of legislation saying that every strategy is implementable and you can use the capital instruments, the liquidity support. So you need to have no doubt about the possibility to use resolution instruments during the crisis. That's the first point. But then you also need authorities and banks that are prepared for many strategies. It is not very common. Now it looks like it is like common knowledge that Credit Suisse was in a situation to be acquired from another bank, but this is a new assumption, because until the Credit Suisse case, we were all convinced that no GSIP may have a sales strategy. So this assumption was wrong in the Credit Suisse case. So we were able to have an effective solution, not a perfect one, but we were able to make a sale of that bank. And I think this is an important point. If you want optionality, you need legal certainty, but you also need banks and authorities prepared to act.
Absolutely. Fully agree. Many thanks, Alan. Seraina, also for you, the last question, and let me go back to this concept of lender of last resort. How do you see the differences between the banking union and other jurisdictions? I think you've mentioned this more or less already, but please.
Yeah, the key difference is, of course, that we have two levels of governance involved, and actually, it's ELA is really provided by national central banks, right? So there is no harmonized framework in place. It's a fragmented framework, and therefore not a particularly powerful second line of defense. If I can maybe follow up briefly on what Alain said about the Credit Suisse case, and maybe one key takeaway, apart from the fact that you should really adopt the ESM backstop, another key takeaway from Credit Suisse, I think, is really, it goes into what you said, Roberto. Credit Suisse was unable to obtain ELA to a very large extent because it just did not have the collateral ready to do so. There is challenges in mobilizing collateral, we all know that, but in the Credit Suisse case, they really became obstacles. And therefore, I would really highlight the importance of the work that is being done in ensuring that these legal, operational, and valuation obstacles are overcome ex ante, that this liquidity can be provided quickly. So my last point, and that brings me back to ELA or central bank facilities. Of course, ideally, banks would know what kind of collateral requirements they have to meet, right? So it's a question of offer and demand that needs to be solved and brought together. So with that, I think I'll stop. The clock is red, and
many thanks.
Thank you.
Thank you, Seraina. Pamela, last question for you, and I will go back to these currencies or different currencies issue. In the different, or with the different jurisdictions you are working with, do you see different strategies there in order to cover this risk?
So, I mean, the situation is much worse in our client countries. FX holdings are up to, on average, actually around 50%. In the loan portfolio, in some cases, up to 80%. So it's a real issue. There is an additional problem. You mentioned it before, Denise. The lender of last resort is very limited in many Western Balkan countries. They are operating under exchange rate regimes. So the ECB swap lines have been tested. I mean, the expectations they would be available in resolution. But in terms of operationalization, liquidity playbooks, our countries are thinking about it. They're looking, into what you are doing. What we do see a heightened interest in, also because of these special vulnerabilities in our client countries and the limited size of the resolution fund, is a heightened interest in external backstop funding. So in order to add some complexity, but with the objective of in the end, simplification, there are discussions, and in some countries we already have that to a certain extent, a 2A layer of defense. So between the internal resources, the industry funds, and the resort to public support, the World Bank can come in, or other IFIs, with a backstop funding. So we do have standby credit lines which we can offer to resolution funds or also to deposit insurance funds in US dollar, euros. We can provide a liquidity to the funds to further stream it down then to the resolution case.
Excellent. Many thanks, Pamela, and many thanks to all of you for being concrete and concise with your answers. I think that now we have 5 minutes, and I would like to open the floor here for questions. Yes, please. And then here.
Thank you for giving me the opportunity to ask a question. I'm Arnaud Santoir with BPC Head of Resolution. And my question would be to Alain Girard. You gave us some insight about what happened with the management of the Credit Suisse case. Can you develop a little more on figures when you mentioned the support that you could gather in the following weekend? Because you mentioned that there were dozens of billions of outflows in the first days, but what does it lead to when it comes to figures for this following weekend?
I'll be happy to, and I will be able to come back on my first word this afternoon, massive. Well, the total amount that was ready to be used during the resolution weekend was about 250 billion. The balance sheet of Credit Suisse was a bit more than 600 billion at the time, and we had a buyer, UBS, with a bit of a bigger balance sheet. And 168 billion have been used for that. Out of that package. Now, what we have seen, and Serena mentioned that, is that I called it the second line. Well, the collateral that was at disposition of Credit Suisse during the crisis was around 50 billion, which means that during the October bank run, the first bank run, Credit Suisse has no necessity to tap into that. They had enough HQLA, more than 230 billion. So they were able to withstand the first bank run without using the second line. But the second line with 50 billion, when we were able to observe what was happening in the market in October, we knew it would maybe give us 2 to 3 days. And this is exactly what happened in March, because in March, up from I think the Credit Suisse made it public that they used their collateral to get emergency liquidity assistance during the night from Wednesday on Thursday. And between that moment and Friday, this line was over. So, and this is public information, on Friday afternoon, they had to tap a second kind of the second line, which is called ELA+, meaning it is collateral that is given without, well, not, this is liquidity that is given without collateral from the central bank, and that was a necessity to be able to bridge to the weekend when the public liquidity backstop kicked in. So that's the figures we had in the Credit Suisse crisis, and if you compare the whole figures, you have a capacity of 250 billion that have been activated, 170 that have been used, and the balance sheet was about 600. So you see, if you have a bigger GSIP, the figures will be probably even bigger. So that's a huge amount of liquidity.
Many thanks, Alan. Here, the second question here, please. Thank you.
Hi, Brendan Pinch from DNB. Question for Miguel first. 80 billion of the SRF, can it all be lent on an uncollateralized basis to one bank, or would that require the approval of the plenary?
The SRF can be deployed just for a single bank and without collateral. I mean, in the regulation, we don't have the obligation to lend this money collateralized.
Okay. And no plenary approval required for that?
No, we need a plenary approval.
So it's subject to the veto problem that the ESM has as well. On the US dollar, I understand the SNB used the FEMA facility rather than the FX swaps, and that required the, obviously, provision of the collateral. My question for BDI and Banque de France, what treasuries do you have on your balance sheet that you could use to raise dollar funding, given the doubts about the availability of the FX swap facility going forward? I mean, do NCBs in the Eurozone hold US treasuries or other US dollar-denominated collateral on their balance sheets that could be used, repoed via the FEMA facility? I think SNB obviously engages in currency management exercises, so it had a lot of treasuries at its disposal, but I don't think our NCBs do. But I'm happy to be corrected.
I don't think you should have the impression that I describe the different lines of defense that are in place today. I mean, to face liquidity risk in a foreign currency. I don't think that these lines of defense are challenged and cannot be activated in case of need. And when you look at market conditions, I don't see any specific tension in terms of US dollar or other currency funding pressure from European banks' perspective. Then mean, if I understand your question correctly, there are a number of levers that can be activated when faced with liquidity tensions. I highlighted the first line, which is the bank itself. I mean, the role of the central banks through those swaps. You can also utilize other sources of financing in case of need. So I'm not sure, I mean, that there is a specific issue as far as central banks are concerned. You speak about that, the role of that specific institution. I mean, we have a number of assets that on our balance sheets can be mobilized in case of need in periods of crisis. So the array of tools is actually rather large. Indeed.
Well, many thanks. Unfortunately, we don't have more time. So we've done a lot. Something more has to be done, that's for sure. But for the moment, I will ask you for a big applause to this panel. Thank you very much.